Hello, everyone. My name is Arhan Parekh, and I'm a financial analyst at Zumit Capital. Welcome to part one of my course, Blockchain, a step towards a decentralized economy. These are the following topics that I will be covering in this course. So we'll start off with the fundamentals of Bitcoin, where I'll talk about the Bitcoin white paper. So I will emphasize on Bitcoin primarily because it is the oldest cryptocurrency, and currently in terms of market capitalization, it is the largest cryptocurrency, covering roughly half of the whole cryptocurrency market capitalization. Then I'll move on to talk about blockchain, which will form an integral part of today's session, since understanding the link between blockchain and cryptocurrency is a key thing for investors who are invested in cryptocurrencies. And lastly, I'll talk about decentralization, another important aspect of today's discussion, because without decentralization, the cryptocurrency environment would not exist. And I would also try to explain everyone what the link between cryptocurrencies, blockchain, and decentralization is. So it is easy for investors to understand the whole technology and why it is revolutionary. So before I get started, I'll give a brief background about our company, Zumit Capital. So Zumit Capital was founded in 2017 and is a boutique portfolio advisory firm that specializes in building and managing equity portfolios in Indian markets, is assists investors in global markets, provides advisory services in cryptocurrencies, as well as provides clients with technical trading calls. We are also present in the investor immigration space, where we provide movement solutions to aspiring high net worth individuals. So without any further delay, I will get started with today's agenda for the course. So start off with the fundamentals of Bitcoin. So Bitcoin was created by an anonymous individual back in 2008 by the name of Satoshi Nakamoto. So nobody knows who Satoshi Nakamoto is, whether he or she is a person or a group of people or so on. And the reasons Satoshi Nakamoto has remained anonymous till date is due to possible regulatory backlash. So when Bitcoin was created back in 2008, this was the first time ever where a digital transaction could happen without a third party or a bank. And till date, it is only the government of a country or someone who is legally authorized is the one who takes care of all these transactions. So, fearing all that, Nakamoto has always remained anonymous and nobody knows till date who he or she is. So, Satoshi Nakamoto defined Bitcoin in the white paper as a peer to peer version of electronic cash, wherein you do not need a third party, such as a bank or a financial institution, that would take care of the transaction. So, what Bitcoin does is that it technically eliminates the trust factor. Now, think of a typical digital bank transaction. So, let's say if person A wants to send money to person B, person A would need to know the name of person B, the name of the bank branch, the bank account number, so on and so forth. So it requires a lot of data sharing. And what this can do is it introduces the risk of hacking, because if personal data like this is leaked, or if hackers come in and get some personal information, it can prove to be very costly. Now with Bitcoin, what happens is, think of cash. When you, like, let's say if I go grocery shopping today, I buy four things and it is worth 500 rupees. If I go and pay using cash, all I have to do is hand a 500 rupee bill to the cashier and take my things and leave. I do not need to know the name of the cashier, neither need to know about his or her bank account number, bank details, so on and so forth. So think of Bitcoin as that. Obviously, it is not as simple as just handing over a bill, but it is a lot simpler than the whole complex legal structure that surrounds typical digital banking transactions, where the bank or financial institution, which is the intermediary, needs to act and regulate and verify and validate the transaction. So before we move forward, it is important to understand why Bitcoin was created. So one of the primary reasons why Bitcoin was created was due to privacy issues. So as you all are aware, back in 2008, there was a financial crisis that started in the United States. And the aftermath of that financial crisis was so bad that a lot of institutions lost trust in banking and financial institutions. So it was after this event that Satoshi Nakamoto came up with this proposition of Bitcoin and released the white paper. And created this whole infrastructure where you do not need to rely on someone who would look after and take care of your money. Other reasons why Bitcoin was created are anonymity and encryption. So, as I explained earlier, in a typical bank transaction, you need to know all the possible details of the person who you're sending money to. In the case, and this is made public. So, the bank, you have to share all this with the bank, and this is where hackers can come in. Now, in the case of Bitcoin, all of this is anonymous and encrypted. So, let's say if I send money to someone like via, let's say if I send a Bitcoin to someone, even though there will be a special key that will be associated with me every time I do a transaction, it is a 26-digit alphanumeric key and it is always encrypted. So even if I publicize that key, no one will know that, okay, this key means Arhan is transacting. So all the transactions are kept secret that way. And the other benefit and why it was created is transparency. So now with a typical bank transaction, let's say if I'm sending money to you, it is only me, you, and the bank who are aware of this. In the case of Bitcoin, everyone who's on the network can see. But the good thing is that transactions are anonymous and encrypted. So even if they can see that, this 26-digit key associated with person X send money to this person Y, they would not know who that person X and person Y are. So even though transactions are visible, the identity of the sender or receiver is never revealed. And the last is immune to hacking. So as I talked about earlier, in a typical bank transaction, when you give out personal details, there is always a case of hackers stepping in and misusing your personal information. Now, in the case of Bitcoin, till date, Bitcoin has never been hacked out of someone's wallet, or there's not been an issue on that front. So these are the few reasons why Satoshi Nakamoto created Bitcoin. Features of Bitcoin. So the first 2 points, open source software and decentralized, are the two most important features of Bitcoin. So open source software means that it is not locked or regulated. Anyone is open to comment and edit and work on the software. So it is open to all. Open source means open to all. It's not as if there are only a few people who can make changes or work on it. It is open to all. Everyone can contribute to it, and it is a system of fairness because everyone is getting an opportunity to do whatever they can. Decentralization. So I'll come to decentralization later in this course, but just to give a brief overview, decentralization in where there is no control by a single entity or a group of people. So in a typical bank transaction, there is someone at the forefront of every transaction who validates or regulates and accepts or rejects that transaction. Whereas in the case of Bitcoin, it is not as such. It is decentralized, meaning there is no single entity or power, no single entity that is in power. The third point, limited supply, is also a key benefit and feature. So think of the US dollar. The Federal Reserve of the United States has unlimited power and they can print as much money as they want. So back in 2020, when the pandemic hit, the US economy was in a really bad situation with a lot of unemployment, and the economy was heading into a recession. So what the Fed did is that they printed dollars, they kept on printing dollars and pumped it back into the economy. So it was sort of an artificial effect where they, even though the harsh realities of the pandemic were being seen, like people were losing their lives, people were being out of work, the economy was not affected that much because the Fed just kept on pumping money. Now with so what happens is when you increase the supply, when you print more money and you increase the supply of it, what happens is the existing value of the dollar that you hold in your hand in your bank account, it loses its value. This is just simple economics. When demand stays the same but supply is being increased, the commodity, good, or whatever you call it, is not considered scarce anymore. It is available in abundant. So its price will decrease because there's just so much of it, and the demand has remained same. With Bitcoin, there are only a certain number of Bitcoins that are available to be mined, which is 21 million. And they should be mined in the coming 120 years. By 2140, it is expected that all the available Bitcoins will be mined. The last 2 points, transparency and anonymity, I touched in the previous slide. So transparency means that it is open to everyone, and anonymous means the identity of the sender and receiver are never revealed. It is just the alphanumeric code, that is a key, 26-digit key, that is associated with each person's transaction. But you cannot know that, just looking at that key, oh, okay, that is Arhan, or that is person X, or that is person Y. So even though it is made available to everyone, nobody's personal details are revealed. Now, Bitcoin transactions. So Bitcoin transactions take place on the blockchain network. I will come to discuss blockchain in a few slides, and they are verified by miners. So miners are people who use supercomputers. So supercomputers are computers with immense computing power. So these miners, they are the ones who verify the transaction. So let's say if I want to send Bitcoin to someone, there is someone who validates that transaction. So they are referred to as miners. And miners, it doesn't mean that it's one person who does it. There's a group of, there's everyone on the community who's present. And the person who's the first one is the one who actually ends up mining it. And they are the ones who get rewarded, which I'll touch upon in a bit. So these transactions, they are recorded in a ledger. The ledger is blockchain, and they're stored in digital wallets. So just like how you have a physical wallet where you keep your cash, your credit cards, your driver's license, or other IDs, these are digital wallets that are you can have on your phone, your laptop, your iPad, or whatever tablet. So when you want to transfer Bitcoin to someone, or you want to use Bitcoin to purchase something, it gets debited from your account, your Bitcoin wallet. So now, yeah, just a brief overview of the whole procedure. So let's say if I want to send money, send Bitcoin to person X. So what happens is a mathematical problem needs to be solved. Okay. And once, so here the meaning of mathematical problem is not that, it's a simple math problem. It's where you require immense computing power. So in the previous slide, when I referred to the fact that the miner is the one who's the first one to solve this, the person who has the strongest computer, like the immense computing power is required. So whoever's the first one solves the problem, they are the ones who then broadcast the solution to everyone in the network. And here the good thing is that it is not one or two people who validate or verify the solution. It is, you need a maximum approval. So at least majority of the people, so at least 51% of the people on the network need to verify and validate that problem. So once they verify that the solution you have is correct, only then will the execution happen, and the Bitcoin will be sent from your wallet to whoever you want to send it to. So now what happens is blocks are added every time a transaction goes through. And it is impossible to reverse these transactions because every time a transaction happens, a block is added to the whole network. So if you want to go ahead and reverse something, you have to go and delete every transaction that has ever happened on the blockchain network, which requires immense computing power and is next to impossible. So this is the entirety of the Bitcoin transaction, like if you want to send Bitcoin from one person to another. Now, what is blockchain? So blockchain is a decentralized ledger, a transaction and data management system, and the technological breakthrough that highlights the success of cryptocurrencies such as Bitcoin, Ethereum, and so on and so forth. So blockchain has already been in existence for a long time. It is just that since the past decade or so, when the whole cryptocurrency craze came into picture, that is when blockchain started getting even more popular and people started understanding what the technology is. So based on statistics, it is expected that by 2025, the global blockchain economy would be worth $176 billion, and by 2030, it would rise to a whopping $3.1 trillion. So the reason for these gigantic and astronomical numbers are that, as I mentioned earlier, blockchain is not a completely new technology. It has existed for a while, and now it is being used in cross-border payments and various other sectors. So it has already been in existence and already being used. And that is why with the advent of cryptocurrencies and Bitcoin, it has just gained more traction and popularity. And that is why these numbers, these astronomical numbers are actually like very much achievable. So breaking blockchain down. So for everyone from a non-tech background, I feel it's important for them to understand what blockchain in its most basic meaning means. So think of the word, so think of blockchain, you can think of blockchain as a very basic example of a database. So a database is a file that collects, stores, and organizes data. So now let's say I'm the CEO of a company, and let's say I have my costs segregated into 4 quarters of the year. So I'll have employee salaries, I'll have rent, I'll have utility costs, miscellaneous expenses, so on and so forth. So what I can do is I can have 4 different columns for every quarter, and I can jot down how much the rent costs, how much salaries cost, how much XYZ costs. So what the whole spreadsheet would do is it would link each and everything and then sum up and give me the total expense for every quarter as well as the whole year. So what is happening here is that everything that is in it is being linked and connected, and then I'm being thrown out a number which represents the total cost. So think of it as a database in its most basic form. Now just break the word block and chain in 2 different parts. So now think of block as every so as I mentioned earlier, every Bitcoin transaction that takes place, a block is added to the network. So block is when any transaction takes place, that's a block. And now think of chain. Chain is something that connects 2 things to each other. So now in this diagram, you can see 3 blocks and 2 chains. So the block represents each different transaction, and the chain is connecting each transaction to the block. So in its most basic way, blockchain, every block is being connected by a chain, and hence the word blockchain comes into picture. So now a lot of people might be wondering, how is blockchain related to cryptocurrency? So looking at this diagram, let's say if person A wants to transfer money to person B. So the transaction is represented as a block. And as I mentioned earlier, this block is broadcasted to everyone on the network. And only when the majority of people on the network approve it as being valid, only then will the transaction move forward. So what happens is once this is approved as valid, the block is then added to the chain, which provides an indelible and transparent record of transactions. So indelible means that something that is next to impossible to delete, because now you see every block is being added to a former chain. So as I mentioned earlier, if you want to go ahead and delete one block, you would have to go ahead and reverse each and every transaction, which requires immense computing power. So it is like next to impossible if you like want to frame it in an easy way. And once the block is added to the chain, person B would receive money from person A. So as I mentioned earlier, there are miners involved who are the ones who actually go ahead and solve the problem, and then they broadcast it on the network and they seek approval from members of the community. So a lot of people will be wondering, like, why are the miners into this? Like, what incentive do they get? So the thing is, miners are awarded fraction of a Bitcoin as reward. So a lot of people might be wondering that, like, agreed that, it might be interesting, but at the end of the day, it requires immense computing power, immense energy, knowledge, time, commitment. So why would someone want to be a miner? It is because they get a fraction of a Bitcoin as reward. So they perceive Bitcoin to be a very valuable asset. And that is why they want to invest their time, energy, money, so on in this, because they are being rewarded by something which is a fraction of a Bitcoin. So this is the entirety of the blockchain network, and it shows how blockchain is related to cryptocurrency. So now, can there be a blockchain without cryptocurrency? So first of all, you need to understand that there are 2 types of blockchain. There's a public blockchain and a private blockchain. So a private blockchain is a permissioned network where there are no rewards coming out. So think of a bank or a financial transaction. That is the example of a private blockchain, because there is the bank or the financial institution is the one who takes control of everything and acts as the intermediary. So if you look at the image on the right, you can see there's a lock here, and that lock, which is the bank or the financial intermediary, is taking charge of every transaction that happens. So there are no rewards or tokens or cryptocurrencies that come out of it. It is the bank who does their job, and in turn they get whatever fees they get, and that's how private blockchains exist. Looking at the image on the left, this is the example of a public blockchain. So you see there's an image of a globe because, it is open to everyone. It's not like, it's locked to a particular region or area. So here there is no control. Like you can see it is just completely free and open. And there are rewards coming out of it, which is the form of, like in the case of Bitcoin, it's a fraction of Bitcoin. In the case of Ethereum, it is a certain amount of Ether. So there are some sort of rewards or tokens that come out of a public blockchain, and there is no control. So, to answer the question, can there be a blockchain without cryptocurrency? The answer is yes, because before cryptocurrencies came into existence, blockchain technology did exist in the form of private blockchains. It was just that it was not that popular and people did not know about it to that extent that it was mainstream. A lot of people think that once cryptocurrencies and like Bitcoin in particular came into existence, that is when blockchain also came into limelight. It is true it came into limelight, but it did exist before cryptocurrencies were created. Lastly, so as an investor, a lot of people wonder whether they need to know about blockchain. So now think of it from this perspective. Let's say person X invest in equities. Let's pick any stock. Let's say Asian Paints. So before investing in Asian Paints, you would expect that person X knows, what kind of business Asian Paints is, how does it make its money, who are its major competitors, basic questions like not in depth, balance sheet, income statement analysis. That is next level. But just from a business standpoint, rather than just equity market standpoint, like understanding how the company makes money, who are they competing with, the markets it serves, and just a few basic overview business questions. So if person X doesn't know the answer to even these questions, they are purely a speculator rather than an investor. Like this is when it shows that they are not done their due diligence, and they are just investing in Asian Paints because it is the largest paints company in India and it is considered a blue chip stock. So that is when you speculate and you are investing in it because of your gut feeling. You think that the price of Asian Paints will increase because it's a good company, it's a good brand name. So that is when you're speculating. If you know the answers to all the questions that I had mentioned earlier, like how the company makes money, so on and so forth, you study the annual reports, income statements, balance sheets, so on and so forth, and you do your own due diligence. That is when you're called an informed investor. So answer the question, as an investor, do I need to know about blockchain? The answer is yes, but as long as you understand the technology at its basic level and a few of its applications, you are fine. You do not need to go into understanding each and every aspect of the technology like a tech person would do, but just understand it at a basic level and a few of its applications. So that in turn shows that you have done your due diligence and you know why you're investing in it. Because a lot of people today invest in cryptocurrencies because of FOMO or fear of missing out. They will be like, oh, like three of my neighbors told me that they've invested in Bitcoin and I feel I'm losing out, so I'm going to invest. That is when you're just speculating because others are like, it's going up, I'll invest, it'll continue going up. So you do need to understand about it, because once you get an idea about blockchain, you will further understand cryptocurrencies. And like Bitcoin as an example, since we're talking about Bitcoin, you'll get a better idea about why Bitcoin is increasing in value and why it is considered valuable. Now, moving on to decentralization, which is another important aspect of today's course. So what exactly is decentralization? So decentralization is the transfer of control from a person or a group of people to everyone in the network. So now if you look at the image here, if you check the image on the left, that is a centralized organizational structure. So you see the circle in the center. So all the other six circles, let's represent that. Let's imagine that all the circles are people in an organization. The one in the center is the manager or the CEO, let's say, and the six different circles at the corners, they are six different circles that are not in the center. Let's say they are like six employees or six managers of a particular division who are reporting to their senior. So you see there are no interconnecting talks or or communication that happens. Everyone just reports to the person in the center. Whereas if you see the image on the right, that is decentralization. there is no one particular person who or entity who's in charge. You see, everyone has their own network and they communicate. So why is decentralization important is because without it, there would be no cryptocurrencies. Cryptocurrencies exist on the decentralization network. The whole reason cryptocurrencies came into limelight was because people started losing trust in banks or financial institutions which are centralized. So as I talked about earlier, there are private and public blockchains. So a centralized organizational structure or a centralized hierarchy is the example of a private blockchain. So a bank or a financial institution or the government of a country. Whereas public blockchain is when there is no central control. So Bitcoin was the example of the first public blockchain ever in existence. Because before prior to that, all financial transactions that were digital happened through a bank or an intermediary. So there was always someone or like a group of people who were in control. So people might think that, decentralization seems really important. It's gaining a lot of traction. So why has central control still been inevitable? So it is because there are a few people who want to be in control and authority. So let's take the example of the government of a country. Now, let's take the example of India. So we are a country of 1.3 billion people. Now imagine if we didn't have a government, we didn't have central leadership, we didn't have banks, leaders, chief minister, so on and so forth. There would just be utter chaos throughout the country. Like, how would you expect 1.3 billion people to give their opinion on day to day matters, to talk about policies affecting the country, to talk about ongoing things in the country? Like, forget India. Even if you take the example of any country that has, like, a few million people, it is nearly impossible for everyone to be able to like cast their opinion. And that is why we elect a government, we elect people to represent the majority of the people's views. That is why in politics we have different parties, because they resemble or they try to reach out the message of people who follow or support their party. So in short, you can say that decentralization tends to lead to chaos on a big scale, whereas centralization leads to being efficient and being organized and controlled. So that is why central control still has its charm and has been inevitable. So from trustworthy to trustless. So a lot of people might wonder, like, why do we need to be centrally controlled? So let's take the example of online banking. Like today, I have an account on in HDFC Bank. Let's say I want to transfer 5,000 rupees to my friend who also has an account in HDFC Bank. I go to my net banking app on my phone. I enter the amount. I enter his name, his IFSC code, branch name, account number, so on, and I send the money to him. So here I'm not communicating with any bank employee. So why would I need a bank employee if I can just do this? Like nobody really goes to an ATM these days, or physically visits a bank branch unless you have like a major issue ongoing. But if you just want to send money to someone, you can just do it with the use of your smartphone or laptop. So what we see is decentralization eliminates trust. So currently what banks do is they fulfill trust. Like people bank with HDFC, ICICI, Kotak because they trust the bank. So the banks, what banks currently do is that they fulfill this trust. So a lot of people might wonder, like, why would we then need banks, if something of this front can be done on a digital scale? So to answer this question, and another important part here, trustless doesn't mean that having no trust. It just means that you do not need to rely on someone that you need to trust. Like currently, banks are the ones who you need to trust. But in cryptocurrency transactions through decentralization and blockchain, there is some random person who you never have met, who you might never communicate with again in life, is verifying your transaction. So that is where the whole trustless part comes into picture. You don't need to trust anyone. Currently, you would open an account with a trustworthy bank because it is a question of your money and you need to place trust. Today, people would not go to Yes Bank or Punjab National Bank or any bank that has, defrauded its customers and open a bank because people have lost trust in them. So to answer the question of why would we even need banks if this can be done on a decentralized level, uh, it is because there are a few disadvantages of decentralization. So decentralization is not achievable currently, especially in an Indian context. So as I mentioned earlier, we are a country of over 1.3 billion people. So for everyone to cast their opinion and vote on something, it is next to impossible, which is why we have people elected in every part. Like we have a chief minister, we have a union minister, we have a transport minister, we have an aviation minister, education minister, finance minister, so on and so forth. So what happens with decentralization is you would lose the benefits of centralization, which include being efficient, organized, unchaotic, everything being good, like properly arranged, seen, visible. And at the same time, you would not gain any benefits of decentralization, because what happens with decentralization on such a large scale, like on a country level scale, is that it requires the participation, thought, and planning of each and every individual. So on a country standpoint, that requires a lot of time and effort, which is why decentralization currently does have its disadvantages, and which is why we should not completely, eliminate centralization, but rather think about this on a step to step basis, plan a proper idea, and then go ahead and try to implement decentralization in certain parts. And if that is successful, replicate that success on more major scales and eventually throughout the entire country. So folks, that is it for part one of this blockchain course. And part two will be talking about a few examples of decentralization, but then it will move on to discuss a few other topics around cryptocurrencies and blockchain that were not discussed today. So thank you, and I hope this was a valuable session. Thank you.